Have you heard of narrow banking?
Yes.
So stablecoins are kind of a workaround to become a narrow bank. So in the legislation, uh, the stablecoin issuer is not allowed to pass along interest to the retail buyer. However, the stablecoin issuer can negotiate with distributors like exchanges or even Fortune 500 companies, let those distributors KYC the end user and pass along some of that interest. And essentially what they have is a deposit account that earns interest, which is
Hmm.
a narrow bank. So I think it really raises questions around the core deposit banking franchises in this country. And what all the banks basically announced a couple of weeks ago is that they're going to start building these things on top of open source blockchains like Ethereum and Solana, such that they are interoperable with each other. It's a real innovator's dilemma, I think, for the banks here, but they now have no choice with this legislation having passed.
Welcome to Trends with Benefits. Today, in this special quickie episode, we're going to be talking about the Genius Act and the significance for the stablecoin market. There's a ton happening in crypto these days, and say what you will about the Trump administration, we're finally getting movement on regulations for digital asset innovations here in the U.S. And today we are joined by Matthew Siegel to unpack the Genius Act, what it means for on-chain finance, and how VanEck is thinking about this moment. Matthew, thanks for joining us.
Hey, Ed, how you doing?
Doing very well. So maybe we just start back. So the Genius Act is the premise of our discussion today, but high level, I think it's about stable coins. What are stable coins? And introduce that. Let's start there.
So stable coins are just digital dollars that you can hold in your own cryptographically secured wallet. And what this legislation does is provide clarity around what a stablecoin issuer actually has to offer. So, if you want to call yourself a stablecoin, you can't back your digital dollars with junk bonds. You have to back them with T-bills and other extremely high quality liquid assets. And what this does is really create the first unified federal regulatory regime for these payment stablecoins, and it's going to help make the entire ecosystem interoperable. It's going to give consumer protection so that folks know what they own. And hopefully it's going to turn the U.S. into the global leader in this space, which was not the case over the last 4 years.
And up to this point, I mean, there's been different types of stablecoins. So you kind of alluded to what was going to be required. Can you briefly talk about, of course, you have the fully backed stablecoins, you have an algorithmic type stablecoin. Are all of these things included in this act?
For this purposes, from now on in the US, if you want to call yourself a stablecoin, like we can almost stop talking about the different kinds because with this legislation, there really becomes one kind for payment stablecoins, meaning if merchants are expected to accept these things, then they can just be, pegged at $1 and backed with cash or ultra short maturity U.S.-backed debt. That's it. And then they have to provide disclosures around that so that you can kind of click through and see what exactly is owned. If you want to do those other things, that's fine. A Bitcoin-backed stablecoin or some algorithmic way to try to peg to $1 using derivatives. You can do all that. You just can't call it a stablecoin.
In essence, this kind of sounds like a money market, like a digital money market fund.
Yeah, totally. Have you heard of narrow banking?
Yes.
So stablecoins are kind of a workaround to become a narrow bank. So in the legislation, the stablecoin issuer is not allowed to pass along interest to the retail buyer. However, the stablecoin issuer can negotiate with distributors like exchanges or even Fortune 500 companies, let those distributors KYC the end user and pass along some of that interest. It might be called rewards, it might be called something else besides interest, but through an intermediating process, the consumers over time should be able to get interest. And essentially, what they have is a deposit account that earns interest, which is
Hmm.
a narrow bank. So I think it really raises questions around the core deposit banking franchises in this country. And that's why you're seeing in the earnings reports from the big banks a couple of weeks ago, very notable, JP Morgan, Bank of America, Citigroup, all said that they are going to become active in the stablecoin space, not just the deposit token space, which is, JPM coin.
Hmm.
It's a cryptographically backed dollar stablecoin, but it only works in the JP Morgan walled garden. And what all the banks basically announced a couple of weeks ago is that they're going to start building these things on top of open source blockchains like Ethereum and Solana, such that they are interoperable with each other. It's a real innovator's dilemma, I think, for the banks here, but they now have no choice with this legislation having passed.
Yeah, because this would kind of disintermediate them, right, in the payments franchise.
Yeah, I mean, it potentially it can. But one thing I've been thinking about, regulators often try to slow down the velocity of money, make it harder for you to kind of move funds from one brokerage account to another, from one bank to another, because it's that, when you get into really high velocity of money periods, that's when banks tend to go under and, systemic risks arise. So there's really a push and pull where from the regulator, the Genius Act, I think, is a step towards higher velocity of money, blessing these interoperable stablecoins. And banks are going to have to adjust to that and innovate a little bit faster in order to hold on to their deposit base.
Yeah, it's interesting. There was a Wall Street Journal article about this. I forget when it came out, but they introduced the idea of the narrow bank, and I couldn't quite tell if it was a negative take or just a take.
The courts have basically ruled against these. People have tried to bring a narrow bank to market and they got sued
Huh.
by the regulator essentially and weren't allowed to. So, because the narrow banking also is thought to have potentially systemic effects by bleeding low cost deposits away from diversified banks who kind of rely on that financial repression where you get 0% on your Chase checking account and they're out there lending on the long end, speculating on securities, et cetera. If they lose that cheap source of funding, maybe banks end up shrinking. So
Yeah.
yeah, I'm not saying there's not, there are some negatives potentially to the overall credit system as the world figures out how to deal with this new model. Over time, we think that the decentralized financial system can also support healthy, transparent leverage, and it may pick up the slack. In fact, the total value locked in these decentralized exchanges hit a new all-time high just last week, first time in 4 years. So there is evidence that the decentralized finance has matured and is starting to take some market share.
Who's using stablecoins today? I mean, is it a big market? Is there a lot of activity? Is it a particular type of user?
In terms of the market cap of all stablecoins, payment stablecoins put together, it's over 200 billion, but it tends to be used by commercial players, financial institutions, to
Hmm.
settle their own accounts, which they can do on the weekends, cross-border, at low fees. So while the market cap of stablecoins is relatively small, 200 billion, the amount settled every month is actually greater than even Visa network settles.
Hmm.
So it's a wholesale business right now, but with the Genius Act having passed, that should begin to trickle down to retail. although with the caveat that that may happen outside the US faster than it happens here, just because of the inertia
Hmm.
involved in our interbank credit card reward system, which consumers still really like. And it's going to take some time for stablecoins to develop the same type of features in terms of insurance, short-term line of credit, the ability to dispute charges and return items. Some of that functionality is not yet available with stablecoins. So that's why for now it's mostly a wholesale market.
Who do you think would be the first type of company to launch a stable coin that are not banks? Could it be like an Amazon or a Walmart that such has been reported that they might be working on?
Yeah, I think most Fortune 500 companies are probably looking at this right now. One obvious idea are the traditional financial brokers like Schwab or Interactive Brokers. So IBKR is actually a name we've been looking a lot at. And this week they announced that they are considering launching their own stablecoin to make it easier for their customers to move funds on and off their own platform. So that's kind of IBKR embracing that innovator's dilemma and saying, hey, if stablecoins are going to make money move faster and our franchise is at risk of more volatile flows, let's at least have the best user experience so that we can be a net winner in that environment versus our competitors. So that would be one example. Consumer-facing fintechs. So think of names like Mercado Libre, which is kind of a pan Latin America e-commerce company with strong fintech capabilities. They now have their own stablecoin, and they're using the stablecoin as a rewards mechanism to merchants who are transacting on their platform. Shopify would be another example of kind of a B2B2C platform who's using stablecoins for their on-platform merchants to help them move money faster. And Shopify has begun incentivizing their stablecoin franchise by offering a 1% cash back in stablecoins on purchases. So I think those are the types of companies that are going to be most aggressive. One thing I think is true about disruptive innovations like stablecoins is that often the benefits are to consumer welfare. And when you look at kind of the market cap that is exposed to the theme, there's often more market cap at risk of losing than there is of winning. And so some of it, I think, is avoiding the losers, picking a handful of the winners, and seeing the rest accrue to consumer welfare.
You talking about like old school companies, the incumbents that don't adopt a stablecoin, for instance?
Yes, or and I think banks would be the obvious example here.
Yeah. So you are in your professional life, you're a portfolio manager, you're researching companies as well as digital assets to invest in. Within this realm, I think, right? Within the digital asset realm, do you find that this act is very significant for you or for the companies that you're tracking?
Yeah, so in the VanEck on-chain economy ETF, the Node fund that we've been working a lot on, we define our investment universe as any company that has articulated a strategy to either make money or save money from the adoption of Bitcoin, blockchain, digital assets. So we're tracking company filings, investor relations, materials, conference calls, any messaging to the market. And when a company highlights Bitcoin, blockchain, crypto as an area of interest or where they have concrete plans, that's added to our investment universe. And what we've seen is the number of companies in our investment universe is growing very quickly. So it was roughly 100 at the beginning of the year. It's over 150 now. Yeah, that's where our focus is kind of separating the wheat from the chaff here and trying to pick winners, avoid losers.
You have to be encouraged by what's happening these days in Washington when it comes to regulations on the crypto front. Is there anything else that you're watching, you're hopeful for? Is that a fair question? Be hopeful about Washington, D.C.? But how about just, hopeful in terms of any new regulations coming down the pike, changes that might help and benefit the digital asset world?
I think that most of the easy lift here is done. The foundation is set for much of corporate America to adopt this asset class with more urgency than certainly they had in the last administration. I mean, there's always a wish list. Many of us were hoping for a bit more transparency from the White House on the strategic Bitcoin reserve and how and whether that might be funded. There was a report that came out this week from the White House that was very light on those details. But I think that is more of a cherry on top than the actual sundae at this point, which, there's still a few scoops that haven't melted here, I think, before the midterms, and we can just enjoy tasty delight in front of us.
Great. Matthew, thank you very much for your insights. What's the best way for people to find you?
We write monthly on both Bitcoin and then the broader digital asset space. So on vaneck.com, you can sign up for the research or follow me. I'm pretty active on X, Matthew_Siegel.
Fantastic. Thank you. And thank you for tuning in to another episode of Trends with Benefits.